Hi, this is Theo from electrofx.com. Welcome to this second video in the free video series. At this point, what is expected of you is that you've read the free ebook and you've watched the first video, so you've got your platform set up and you've understood all of the tools that are available to you, how to use them, and so on and so forth. In this video, I'm going to basically pick up here from chapter 4 in the ebook, which is reading price action, and I'm going to really extrapolate and expand on everything I've covered throughout the book. So, let's start with chapter 4. Price action itself really is everything to do with price. I mean, there's a lot of ways that people refer to price action, but one thing that I've discovered in the nearly 5 years of teaching is that you do need a verbal dialogue and a way to differentiate one concept from the other. So, when I talk about price action, I'm simply talking about the highs and the lows that are being made in the swings of price, because that's how I can differentiate that particular piece of the puzzle. And I look at Forex really as a puzzle, and trading, it doesn't even have to be Forex, but trading in general is like a puzzle. If you were to have a puzzle with some missing pieces, then you couldn't finish it, and if you were to try and trade without all the right pieces, then you just won't succeed, or it'll be much harder than it has to be. So I've broken that down in the ebook for you into the pieces that I consider to make this up. And when we're talking price action, we're just talking highs and lows. We want to look at them on two different scales. Since we're using the H4 chart, everything's going to be relative to the H4 chart. So when we zoom out on the H4 chart, we can see which waves of movement, which scales of movement are relative to one another. And in this particular example, if we expand on it a little bit, there's these waves here. Those are certainly relative to these waves here. This stuff here is quite big, but it's not quite big enough. It's more relative and matches better to that stuff over there. So that would be the short term. This would be the long term. As we move over to the current history, these patterns, they're getting quite large, but they're still not big enough to match the relativity of these other longer term waves that we've mapped out. So that's your longer term. Shorter term, we're just zooming into the candlestick level, and you can see the shorter term waves. You certainly have an option up top here. You could actually blend that into one if you wanted. Or you could separate it into two. It's not going to make a huge difference. It doesn't really matter either way, but certainly you could. There's two angles there. Based on what you see over here, some of the sizes that are going on, certainly that's valid. That of course gives you what we call a triangle. Right? That's essentially when we're making lower highs and higher lows, and prices compressing. Alright, it can also go the other way. You could be making higher highs and lower lows, and so the market would be expanding, and that's a different setup, and we'll get there in due time. So for now, price action is the highs and lows being made. Could be making lower lows and lower highs, could be making higher highs and higher lows. It can be compressing into triangles or ranges, making lower highs and higher lows, or it can be expanding into higher highs and higher lows as the market opens up. All right, and that can be happening on both the short-term scale that we're looking at and the long-term scale that we're looking at. Okay, now some people, when they talk long-term trades, it's going to be a lot longer term than what I'm talking about. Everything that we're covering here is relative to this H4 chart, and certainly everything that I'm going to teach you here is a viable option on other time frames. It works really right across the board. I have one VIP member who's doing a lot of this stuff on M5 even, so you can make it work, but as a beginner you need to start somewhere, and the H4 chart is quite solid, and you're going to have a much higher chance of getting your head around it without being frustrated. So that's all I mean by price action, and when I talk longer term and shorter term, I'm talking in relation to this H4 chart. Okay, the next chapter was about what I've named market structure, and it really does tie in with price action. It's a very similar thing, but now we're looking at it in a slightly different light. And we're looking at essentially utilizing one scale, the shorter term, to turn the longer term, using specific market structure patterns to help us understand that we're not alone and we're kind of following the herd. So in this particular example, I've shown the 3-point turn. It's quite simple. It's just that we've had a reaction at a valid area. It's pulled back and it's giving us a higher low, and so that's a 3-point turn. 1, 2, 3. We're off. The next pattern is the trend continuation wave, and it's just expanding on where we started. So it's the 3-point turn, and now we're looking to trade the trend continuation wave. So at the time of the trend continuation wave, it's going to be a confirmed higher low right there, and then a confirmed higher high. We're actually trading the next higher low in the sequence, and that's obviously why it's called a trend continuation wave. Now this is the third wave, and certainly you can continue to trade this. You can take fourth and fifth waves. I very rarely see the market go beyond 5, so I get quite hesitant after that. But this would be the third wave. This would be the fourth wave right here, and then there was no fifth wave that set up correctly, and we'll slowly get into that, the whys of that in a moment. The other pattern that's worth considering is the double tap, and that's very similar to a 3-point turn, only it's reacted more precisely at a specific area. As you can see there, that's your double tap. It's very, very close to this origin point. The first reaction is just reacted to again, so we can call that a double tap. Sometimes that second tap might be a couple pips higher. I mean, it's not going to be a huge deal as long as it's not too far. You've still confirmed the area. Now, a pattern that I didn't mention in the book, because I like to introduce things slowly and not cause any information overload. With those 3 patterns that I've outlined, you can really get everything done for a while. But when you're ready, there's also a split double tap, which can look like that. Some people call them head and shoulders, and there's also a split double tap that happen like that. We sometimes call that a ghost. If we want to separate them, that's a ghost, that's a head and shoulders. But for simplification purpose, we can just call them split double taps, and that works just fine. Obviously they can be as I've drawn them, or the other way around if we're going the other direction. The double tap, some people call them M patterns, some people call them W's, double tops, double bottoms. There's a number of names for a number of things. I like to keep everything very simple and very specific. So double tap is a double tap, and that's that. It could be happening because we want to sell, it could be happening because we want to buy. No matter which way it's going, it's a double tap. Apply that same logic to the split double tap, and it's as simple as that. So now this is what I mean when I say you can use one level of wave activity to turn the other. I've drawn in the longer term using black. I mean, these colors are irrelevant, but I've drawn in longer term, and I've left on these basic patterns for you. So now, if you didn't want to take your education any further and you were happy with larger stop losses, then you could actually now use market structure as your entry trigger into the price action of the longer term wave. And so this particular double tap scenario that I've mapped out is going to be counter trend, your longer term wave, but it gives you a point to enter and a point for your stop loss. And the only thing you need to judge is what kind of reward you can expect. Certainly this area would be viable as long as it's 1-to-1 or greater, but we're going to get into that shortly too. You should understand what I'm talking about though, having read the book. So that's a counter trend. That would be a riskier trade to take. This next trade over here, if the longer term wave were to continue on, you would understand. I can see it because it's off the screen, but it's not in the video. This is a trend continuation wave on that longer term price action, right? On the longer term scale, this is a trend continuation. So then you have a 3-point turn to just verify that the shorter term price action and the shorter term scale, it's got good structure to back you up, and you could quite simply trade that pattern and use the stop loss there, and clearly you're going to be targeting somewhere up in here or higher, giving you really good risk reward. Right, the point is that we can get even better with our risk reward, because we can actually use candlesticks as our entry triggers on top of these market structure patterns onto the price action, and these pieces of the puzzle, they just all come together and work in harmony. Alright, so those are the patterns. That is how one level of market structure can turn the other. It's just, when you're thinking about price action and market structure, I mean, you probably think they are very similar, and they are very similar, but in order to sort of differentiate the patterns from just the flow of the swings, I've separated it into the two categories. Okay, the next item, the next piece of the puzzle, very important, chapter 6, support, resistance, and supply and demand. They really are essentially the same thing, but some people call it supply demand, some people call it support resistance. I have a way that differentiates the type of trade that it is, and for me, a supply demand trade is a preemptive attempt, or a preemptive trade into the turn of this longer term wave. In this example, we're buying, and that's all I can go on. If we were selling and things were going the other way, it would all be in reverse, but for now, this is what we have, so this is what we'll work with. If you think about what was happening on the shorter term wave, then we can map it out. Certainly it would look something like this to you. And so at the time of price reaching this demand area, you have indications to you, and what's obvious to you is that you're fighting the price action of the shorter term scale. And so this is a preemptive attempt to get into that longer term wave. And the longer term wave, as we said, is trend continuation. So you are at least trading with the trend of the longer term wave, but you're fighting the trend of the shorter term wave. And it's really important, especially when you start, that you would not trade counter trend on both scales. So right here, you're trading with the trend of the longer term, but you're trading counter trend of the shorter term. And so as this wave comes down on the longer term scale, I mean, once it's gone long enough, somewhere around there, it's relative to what's been going on at that scale. So now you have something relative, you need to start assessing where this new high or low could occur, and there's not really that many options. I mean, obviously that's an area that it could turn, and this is an area that it could turn, and this down here is an area that could turn. That's it. It's not going to turn in the middle of nowhere. It's going to turn somewhere specific. The market is very organized, and even though there's a lot of talk of this being chaotic, it really isn't. It's very specific, and price moves at specific locations because large institutions do not sit there looking at their screen. They have predetermined areas that they will buy or sell a currency based on how they're reading the supply and the demand. So some of these institutions are trading hundreds of millions of dollars, and you can't just enter the market with hundreds of millions of dollars. You have to do it gradually, and this is how and why our shorter term wave and the market structure of it form. Okay, so in this particular example then, we've reached the demand area. If you wanted to trade that wave of movement right there, it's definitely better to do these on the shorter term time frames, but based off of this H4, and that's an advanced, more a down the road thing that I will introduce. But for now, this is the demand trade, and we have to look at the origin of the area that created our demand zone. And so that was the initial reaction, from its origin. That's what happened. Now, if you are to expect half of that to happen again, you're going to be right most of the time. That's just the way it works. So in that regard, this one actually reacted more than half of that, and you can see that a little bit hard to take on this scale unless you just entered the reaction at the zone, but this is something you could really get into on like an M30 level, so that you could take advantage of this trade while you wait for market structure to correct itself and give you a proper entry into that longer term wave. So that's how I differentiate supply and demand from support and resistance. Supply and demand are essentially these little areas that are created mid-wave, the little hesitation areas. These would be supply-demand areas for me. Whereas the areas that are, this then sort of verifies the area, then it pulls back, then it goes again. That's now a support trade because it's based on swings. It's based on the shorter term swings. So now, to me, it's a support trade as opposed to a demand trade. The trend continuation, that's also a support resistance trade. It's, we had an area and we're just confirming it again based on swings. So, short term swings, side by side, the ones that are happening right now. So that is more of how I would separate support resistance from supply and demand. Now the other thing is, of course, what I call the mirror flip, and that's when you have areas of resistance that become support and vice versa. It can happen the other way. More often than not, these areas of demand are also created. So really you almost wouldn't need to draw that mirror flip area in. You'd still get the demand area, but it's much better to be mindful of what's going on, and just you don't even have to draw it in, but you need to be mindful of it. You need to see it, need to observe it. So we know that this trade here, which is, as we remember, it's the trend continuation fourth wave, all right, that trade there is actually a combination. It's a demand and a support trade, right? It's a double. So it has two pieces of evidence, and that's what this is. This is evidence-based trading. We're reacting to what we see and what happens in the market. We're not guessing. Everything is done for a reason. So here we have demand and support backing up the fourth wave, the trend continuation, and that's a verified trade. Of course, then you have a double top, and you could get into this particular wave of movement. And then after that, because of what happens, you clearly have a confirmed rangy triangulating area, and you need to get out of that before you can consider any more trades. An example of that on the other way, support becomes resistance, and in this case we don't have an area of supply created right here. It's just powerful. It's following the trend. This is a strong trend that's going on, and so there was no hesitation at all. You got these two spikes right out of the area, right out of the mirror flip. Another perfect example, support becoming resistance. All right. So we have these khaki boxes that are drawn for you, and they really do nail quite, most of the areas that are of any interest, but they can't do the mirror flip. You have to do these mirror flips by yourself. You have to be mindful and observant of the mirror flips. You can draw them in if you want, but you don't have to, as long as you're aware of them. The last piece of the puzzle then really is so far, if you think about from the start, you have price action and market structure. That's determining what is happening at two different scales, what type of trade you're in. Is it a 3-point turn? Is it a trend continuation? Is it counter trend on that shorter one, but to turn the longer term trend? We have the way to separate and understand what type of trade you're in and make sure that it makes sense. Support, resistance, and supply and demand allows us to make sure that that is happening at the right location. The last thing that you need is that at that location you need to verify that you're not alone, and you're just going to be joining in with the herd and the big players that are piling in the money, because you're not moving it, this market. So we want to make sure we're not alone. That can be done by immediate price action, which are candlesticks. And the first one I've outlined is a candle eats candle. I call it a KEK for short. And I've also pointed out that this just happens to be a 3-point turn, really at the mirror flip of that large spike, which was clearly a big area, because right beside it you can see a small supply demand area also. So that's a really good location for this to be happening. It's counter trend on the longer term wave scale, but we have a nice 3-point turn to back up the turn of that longer wave, even though it is counter trend. We got evidence to back up its turn. Right, the next one I pointed out is the inside bar, and you can see right there, area of demand comes right into it, gives you an inside bar. That just means that the high and the low of that blue candle is contained within that red candle, and then as we proceed to break the top side of that blue, we have an entry trigger, and whatever location we're trading gives us our stop loss anyway. So you know, we know where we're entering, and we know what our stop loss is, we know what our risk is, and you know, that's what we're going to touch on shortly. Here we have a pin bar. It's at a mirror flip of this other area. It's following the trend of the shorter term wave, which of course we've now turned that longer term wave, and we're just following the trend of that turn until further notice. The way that you could look at this, you could certainly look at these waves like that, in which case this would be the 3-point turn since price reset right there. Or you could combine those together, and this would be a trend continuation wave. Either way, you know, you're following the trend on this one, so there's no debate there for you. You have a lovely pin bar at a great location, and so of course you have an entry point and a stop loss, which is all you need to assess then, you know, if the trade's going to be worth it. Right, quick note on the IB that I pointed out. This IB, it's counter trend short term, but don't forget it's also, if we map out the longer term one, at that point in time it could very well have been part of the initial location, a good place for that longer term wave to have its own trend continuation. So that's why the counter trend was, you know, worth marking out for me, because we're not just counter trend both scales, we're counter trend one but following the other. Okay, so here we moved on to the chapter on, you know, stop loss take profit and risk reward, which is basically the last piece of the puzzle. You know, you can't ever enter a trade where you're going to risk more than you're trying to gain. It makes absolutely no sense. It's illogical. So the only way to be able to take that into consideration is to have an entry price and a stop loss before you actually pull the trigger and get into the trade. And through this evidence-based approach, where we're using price action and market structure along with location to determine all of those elements, and then an entry trigger to get in, we know what area we're trading and we know what our trigger is. So in this case we have a pin bar. It means that we're trading the break south of that pin bar, and it means that above that pin bar is our stop loss. That means we know what our risk is. Now all we need to do is assess our reward, and that can be done through just looking at the market here, saying, right, you know, no matter how we look at it, this previous area that we could call a little triangle, no matter how you look at it, we're following the trend. And so if we're following the trend of lower lows and lower highs, that means we're in our rights to expect a lower low. It would make complete sense. So what I've done is I've marked out the most conservative target you could shoot for. It's the most conservative target you can shoot for because we're actually targeting a higher low. And if you're targeting a higher low on a trade that the structure and the price action is saying is going to make a lower low, then obviously that is your safe play. You don't have to be that safe, and there are several extremes you can go. We always want to look at the horizontal areas, it's no doubt, but if you want to judge the momentum, then at the point of entering this trade here, you're entering it because you believe you're right. Otherwise you would not be entering it. That would be silly. So if you then base your next set of judgments on that same fact, it means that that will then be your next lower high. Right? You have this lower low that was just created, and certainly you have the previous high right there. So you have 3 points of information on the chart. We can then draw an angled line. You can use the equidistant channel, and I'll go over that in the next video as I get deeper. You can spread that channel open and it will be a parallel line, and join it up with the low. I can do it by eye. It's kind of tough. Alright, that's messy. So I'll do that again for you. Alright, you're joining your highs that you know, and you stretch it open so you have a nice channel, and draw in, and it will be parallel. It'll be something like that. So now you have a very safe take profit at the conservative target I've marked. You have now, based on momentum, your most ambitious target that you could possibly shoot for. And so targeting right smack bang in the middle of those two becomes a very feasible option, and it's actually not that risky to do. Alright? If you want to remain conservative, you can do so, and you won't need to worry about any of this. This is a little more advanced, but it's really not that hard to understand. So if we are going to shoot for a lower low, we also want to look on the horizontal. Where's the next area that is in the way, the next obstacle, and that's, I always call these obstacles. So obstacle number 1 is the low that we just had. Obstacle number 2 looks like it's going to be right there. Alright, so coincidentally, whatever or not, this is lined up perfectly with obstacle number 2, and that's another way that you can think about it when you're following the trend of the wave scale that you're trading, which is the short term. If you're following the trend of the long term as well, that's just even better. But if whenever you're following the trend, you're expecting these lower lows in this case because we're selling. That's really the way you can think about it. Obstacle number 1 is here. Obstacle number 2 is here. And so because we're following lower lows and lower highs, we can go obstacle 1, maybe go to break even at obstacle 1, obstacle 2 being our target. That will of course increase your reward versus your risk, and we want to essentially keep the rewards on the upper side as much as we can, because then, if you were only winning 50% of your trades and you were always getting more than you're risking, you're pretty much ahead of the game. So it then becomes a game of simple math. But like I say, as this is just pieces of a puzzle, and all the pieces together make a complete formula that works, and you can really base a high probability success rate on your trading if you follow all of these rules. It's not even that many. You've got price action, the market structure, which is really tied into price action, very similar category. Supply and demand, and support resistance. This is for determining location. Alright, the momentum based approach that I just outlined for determining your most ambitious take profit and reward on this trade using the angled channel, you can also do that when you're trying to judge where a longer term turn is going to be, and I'll actually touch on that in a moment here. This is your basic chart. It's quite naked, there's no garbage on there, there's no squiggly lines everywhere. This is just price, and price is reacting at specific locations for a reason. There's generally evidence to support anything you need to get a good trade. You won't get them all. I mean, you're still going to get the odd bad trade, but you know, that's just part of the game. It's part of winning is having losses. You cannot win 100%. You know, it's just not possible. So when we look at this and we look at the way I've described market structure to you and price action, I just want to show you what we've developed as a sort of the next step if you like what's going on, if you're doing well and you want a little more help and you want to enjoy the extra benefits that I do have in the next level of membership. This is something that I've developed over the last few years really, and it's based on about 7 years of trading, and I call it wave effects because it, you know, as you can see as I flick back and forth, H4 chart, wave effects chart, the gold line that you see here are our short-term H4 swings. So when you're using this H4 chart, you're looking at the short-term swings and the long-term swings. But when you're using a wave effects chart, you can actually see the short-term swings, which are the gold. You can see the long-term swings, which aren't marked on, but you can see those. But you can also see the inner workings of the gold. And so we've got another level to watch. Here's a 3-point turn to really confirm that particular short-term wave. You know, here's you know, you've got these double tap, split double tap patterns right there. Things start to stick out to you a little bit more because these are timeless charts, and you know, these various softwares have been developed over the years, and I just wanted to introduce you to that. You can do everything that you need to do on the H4 chart. I mean, it's not a necessity. I'm showing it because it exists and it's what I use myself. Alright, so back to the candlesticks, because the points of interest I wanted to make was some areas that I think people could go wrong and perhaps get a losing trade. The first one that stuck out to me was right over here on this point. It was a mirror flip of that area, as you can see, and so then you have an inside bar and you could start thinking that you wanted to enter there. But what I want you to note about this particular part is that it was followed by another inside bar of itself. So now you've got two inside bars. What that really tells you is that you're having a triangle situation on a much smaller time frame, and therefore you really need to break out of that before you can consider a trade. So you know, the only way to do that by not using another chart and sticking to one chart is to, you know, we're not allowed to use that anymore because now it's got another one within it. So now we look to the root that contains everything, and it's the next one back. Alright, so when you're looking at that in that respect, then now you're actually looking, that's your entry trigger. You know, you're looking to trade south on that if you were going to. Clearly, as you can see, the risk reward would be quite dodgy even on the second thing, but you could probably scrape it. Point is that you're not entering there because it's not a clear verified signal. The pin bar is nice and clear, and that was a nice spike reaction and very decisive, and off they went. Over here we have an inside bar, and the next one's small, but it's not an inside bar of the inside bar. It's actually spiked up, and it's given us what will very well be a double tap on a much smaller time frame, which are these two spikes right here. So we have enough information still, enough proof is still there that, you know, this area is good and we're not alone. Alright, so that's the little knick-knack that I saw and I wanted to point out. You know, there's a lot more to it, but there's no point in overloading you to start with. What you have thus far is enough to successfully trade. You just need to be patient with it and do things correctly. So I wanted to go back to this screenshot as well, because I can point out what I meant by judging some momentum. Right, you have these 2 points because you're trading this higher low. You know, you're trying to get into this higher low. You've got good structure and patterns and plenty of opportunities to get into this, and treat it as a long-term wave. It's always hard to do this by eye, but now you have this channel. You've got these expectations of, you know, where this trade could potentially reach. And so your conservative take profit on the long-term wave is a slightly lower high. And because you're clearly, it's trend continuation on this longer-term wave, you're expecting a higher high. But to be conservative, the safest play you could have is quite clearly a lower high. So now, if you just kind of nail a spot right in the middle, that becomes a very reasonable place to target also. This becomes the most ambitious target. In this case, it looks like it just clips it. So, you know, those are your three opportunities there of take profit. The point is that you really want your conservative take profit to be 1-to-1 or greater than your risk. And anything that you are able to expand on from there and move your take profit further just increases your reward. Your risk's still going to stay the same, all right? But your risk reward is going to stretch out very nicely. So when we look back to that, it's an example of really working that longer term wave, and you do have a choice of simply working these shorter term waves whilst observing where you are within that longer term wave, or working the shorter term waves until you are actually in these longer term waves and then treating them accordingly. Okay, so moving on in the ebook, the next chapter is on trading psychology, and there's not really much more I can say about it. It's something that you're going to have to study yourself. My words of advice to you would be to really understand these, you know, what I feel are quite simple concepts, and really get a proper grip on what you're doing, because you don't want to be thinking about it live. You want to have assessed everything that you need in the backtester, on the historical data, really cleared your mind on what's going on. In the next video I'm going to show you how to use the strategy tester to simulate a real life environment to actually make one candle appear at a time, and, you know, do this on paper and make sure you're getting the entries right and what have you. But, you know, that's going to be part of the process of the learning and getting a proper grip on each of the concepts that I've outlined and how they work together harmonically. So, you know, the other part is going to be experience and time. And once you've established a cement knowledge base of what you're doing, and it's no longer requiring thinking, you're just reacting, then you're going to have to go through a duration of time where you see it working live and you believe in yourself and you trust yourself, because you have to trust what you're doing and yourself. Once you trust yourself and what you're doing, you know, that's pretty much it. You're off and running, and that's the end game. The other thing that I would mention is a lot of people do well on demo, and then as soon as they go live, everything goes out the window, and that's all down to the psychology. It's nothing you can do. The mind is a funny thing, and it will have you doing things that are completely against what you believe in, because you're thinking about the money, and I don't know. It's something I've been through. It's something everyone I know that trades has been through. There's no real way around it. You're going to have to go through it. So it's better to go through it on a micro lots account or something. You know, maybe lose a little bit of money to learn. The demo account will be easy because there's no real psychological effect, and it's just a slightly different story. Okay, I hope I didn't go too fast, but I wanted to keep things flowing, and I hope this has really clarified the ebook and brought to light a few more things. I'm going to make another video, and we're just going to pick a new different chart. I don't care which one it is, and we'll take a look at some more trades, and I'll just try and cement everything that I've said in this video and in the book a little bit further, and then I'll show you also how you can practice in a real-time environment.